We'll get to some of the bad things or difficult things that are happening in a minute, but just to stick with your company story for a minute, a key part of this acceleration that you described happened in 2016 when you completed what I read is a $67 billion deal to acquire EMC Corporation, the largest technology merger in history. EMC is a data storage, cloud computing, related services company. Obviously, nice to have, but you had to take on close to $50 billion in debt to buy it. And I'm wondering, as you look back, that's now 5 years ago, whether that strategy seems to you to be validated by what happened in the marketplace.
Well, it's worked out very well, certainly for our investors in the various transactions, everyone's been nicely rewarded, and the company has built a industry leading position in cloud infrastructure and all things technology that help customers kind of accelerate their digital futures. And what I also observed, and this kind of started in the mid to late 2000s, was that debt was getting just way less expensive. And of course, that's only continued. I think Bernanke talked about the savings glut in the mid 2000s, and the cost of debt capital has just gotten less and less. And we've been able to pay down debt at a very aggressive rate. Last week, we had a 2-notch upgrade to investment grade from S&P. So I guess there's a great validation of our progress in the transaction. But yeah, feel great about it, and certainly debt used smartly, to buy highly productive assets that generate tremendous cash flow. Can be a great way to, create a lot of value, which is exactly what we've done. And at the same time, built a much stronger company to serve our customers. The first half of this year, we had over $50 billion in revenues. We grew 15% in the last quarter, and second half is going to be very strong as well. So feeling great about the position of the company now. 5 years after the largest merger acquisition ever in technology.